All right, let's get started. Good morning, everyone, and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get going, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today will be kicking off with the major equity indices, highlighting those key levels, and we are seeing a pullback across the board, but the big question is it a pullback or a reversal? My bias does still lean to a pullback. I still believe overall sentiment is quite bullish, but price is recovering from what was a technically overbought condition over the last couple of weeks. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at just the one subsector of interest that I have for you today. And as usual, end today's webinar on by looking at bullish and bearish market observations. So starting off here with SPY, the S&P 500 ETF, and we can see ever since we got that breakout from 420, there was a lot of momentum behind this move. Price was well above the 200 level on the 50-period CCI, indicating an overbought condition, and maintained there for quite some time. However, we are now finally seeing, that momentum come back down to more modest levels. Price is still above 430. And, the big question again, like I said earlier, is this a pullback or a reversal lower? Because there's a lot of headlines on recessionary fears. And the one thing I will say to that is those recessionary fears have always been there over the last few months. And, it hasn't had too much of a negative impact on price action for equities from the medium to longer term. So even if there are some recessionary fears now, this reversal lower, I don't believe is caused because of that. I believe that, the markets have already priced in the Fed potentially hiking again interest rates again in July. That was pretty much known for quite some time, and looks like that will be going ahead unless we get some very drastic data from inflation reports next month or jobs data. But unless we get that, I do expect another rate hike ahead. And this bearish price action that I see, I do believe it's more of a pullback than a reversal, because price was at a technically overbought condition after this very strong breakout. So it makes sense for a bit of a pullback before continuation higher, because everything else is still pretty much constant here with equities. The other headwind that I could potentially see in the future is Chinese data not looking too great. That would reduce global demand. But again, that hasn't been looking great for the last few months as well. And, for that reason, still have a underlying bullish bias here for the S&P 500. So if this is a pullback, where could price head to next? Well, the first area that I'm looking at is actually 430. That was a previous area of resistance and minor resistance. It was also a swing level on a weekly time frame. So we could see price react to that 430 level. It hasn't quite reached that yet, but it could reach it in the next day or two. But if it breaks below that, you have major resistance at 420, which could turn out to be support. That 420 is also the 23.6 level. So that is a very critical area, and we could see some bullish price action there, giving us a much better risk to reward bullish entry point. Upside targets, the obvious one would be 450. Because there was a previous swing level on the weekly time frame and acted as support and resistance as well. So that would be my upside target over the next couple of months. And you also have 480 all-time highs, of course. Right, moving on to the NASDAQ 100, looking at the QQQ ETF. Weekly time frame, 370, major resistance level. We can see it has acted as resistance before, and also quite recently, price reacting to that level after what has been a very strong rally higher, momentum overbought, but has now since recovered to more modest levels. And we are seeing, price actually continue to decline here. So similar argument with the S&P, where is this a pullback or a reversal lower? I still think it's a pullback. And depending it depends on where price could potentially head to for this pullback zone, because we have 350, which is a psychological level as well. And it also did provide some level of support on the weekly time frame. So we could see price pull back a little bit further there. But the next key level is all the way down at 330. So that's a significant decline. That'll be a very significant pullback. I'm not sure if price will pull back that far. But the Nasdaq 100, there is still plenty of underlying momentum, especially on the weekly time frame. And this pullback doesn't really worry me too much. If anything, it's probably a good thing to see this pullback, because it means that we can actually look for better bullish opportunities instead of buying into overbought territory. Upside levels, again, 370 to 380, that is a key resistance area. And then from there, you're looking at all-time highs of just above 400. Right, moving on to IWM, which is the Russell 2000 ETF. So small caps, after giving some initial encouragement with this breakout above 180, and it wasn't just a breakout, it was a breakout with significant momentum. We saw the 50-period CCI almost reach 400. So there's plenty of momentum behind this move, but immediately stopped at this 188 level, which also happens to be the 38.2 fib level. So IWM, once again, respecting its key Fibonacci levels. You can see consolidated there a little bit, but has since declined here. And it is underperforming the NASDAQ and the S&P. So once again, small caps underperforming large caps. And also indicates that the performance in large caps the last few weeks is really attributed to the top 10, 15 companies, Apple, Microsoft, Google, Amazon. Those companies have been doing well, but we haven't seen market breadth really improve during that period. So there was very narrow leadership, very little participation in the rally. And small caps, kind of makes that quite obvious, because we are not seeing small caps outperform or even, perform in a similar way that the S&P and the NASDAQ are. Because those two major indices have those, the top 10 companies in market cap. So in terms of the price action here, we have 180, previous minor resistance level, price retesting that once again. And even yesterday, we saw some interesting price action, a move higher earlier in the day, immediately rejected at 182.50, and also the 21-day exponential moving average. Set to open a little bit lower this morning. So we'll see what happens here. But if we get a breakdown below 180, that opens the door for 170, which is the 50% fib level once again. Now, I do expect the 50% fib level to hold quite strong, considering how well it did, during this period of consolidation. Even on bearish days for the market, the IWM was still managing to stay above 170. So that is encouraging in a way, but obviously, the fact that price doesn't really look like it's finding that much support at 180 is not so encouraging. Taking a look at TLT, the Treasury Bond ETF. So TLT weekly time frame quite bearish. 108 is the major resistance level, as you can see, and was a previous swing level. And price has been pretty much range bound between 108 and 100. Now, taking a look at the daily time frame, you can draw another minor area of support at 104. As you can see, price on the daily time frame did find some support there, eventually managed to grind below that and found some additional support at 100. Coming back to retests at 104 level, so far it has been failing on multiple attempts. So price is definitely getting a little bit squeezed here. There is some buying pressure due to the fact that price is not really looking like it's heading back down to that $100 level, but it is running into some resistance at 103. So might be a matter of time before we see a breakout above 103, 104, and a continuation higher back up to that 108 major resistance level. As for the risk reward, tough to say. If you look at the bigger picture, where price currently is, it's bang in the middle of no man's land between this larger range of 108 and 100. So for that reason, I wouldn't really be looking to trade this just yet. Even though price is rejecting 104, it doesn't really look like it's moving that much lower. Its price, if anything, is getting squeezed up higher and higher to that resistance level. Right, taking a look at the US dollar. So the US dollar has been very choppy lately, and this is a bit of a bigger squeeze, in my opinion. So overall, a bit of a bearish trend on the weekly time frame, but price finding a major area of support, here at 101. Since then, we saw move higher, with price looking like it was going to head to the 105.50 level. Didn't quite get there. And that means that this is technically a lower high. However, we are seeing price also making a higher low compared to the previous low. And this simply means the price is looking like it's going to be squeezing here, and we could get a breakout or a breakdown. Big question is, where would price go if there was a breakout or breakdown? Well, upside resistance stays at 105.50, downside resistance or support stays at 100 or 101. But yeah, right now the dollar definitely going through a consolidation period, and price action is very choppy. Moving on to gold. So gold overall, bit of a bearish trend here on the daily time frame. On the weekly time frame, it did post a huge triple top. I may have cut out the previous swing level, but that was also a triple top with a rejection at 190. Since then, price has been declining, breaking below minor support levels at 184, and again more recently at 180. There's another minor support level that was broken, and price clearly under pressure. However, price action very, very choppy. So while the overall trend does remain bearish, I think if you are going to trade gold, especially to the downside, you'd have to be patient. This choppy price action is not great, psychologically speaking, for trade, because it'll take a lot more time to actually continue to move in your favor. Next key level would be at around this 170 area. That's significant downside. However, gold is under pressure. It's a safe haven. And the fact that we're in a bit more of a risk-on sentiment with equities over the last few weeks, we are naturally seeing a steady rotation out of gold. Okay, taking a look at oil. So oil is actually moving to the downside. Again, very, very choppy price action though. So we initially had a larger range between 81 and 70. And price was respecting that range for quite a bit. There was news on supply cuts and all of that, but didn't really have too much of an impact in terms of a breakout or breakdown. However, more recently, that area of resistance from 81 has been shifted down to 74. So we are seeing resistance at the 74 level, price struggling to break above it, but finding some support at around 67. Now, if we take a look at the last few days, you'll notice that price hasn't actually quite reached a 74 level. It's running into resistance at the 55-day exponential moving average and continuing to move lower, but still finding some support at around the 68 area. So overall, price is getting pressured to the downside, but respecting some support. And that, for me, indicates that we could eventually see a breakdown and a revisit down to 63. Now, when it comes to the fundamentals of oil, on the supply side, yes, oil producing countries are looking to cut supply to increase price. However, the more bigger macro catalyst here is actually the fact that Chinese data is slowing, and China is a huge consumer of oil. If we see bad Chinese data, what tends to happen is that oil prices would move lower, and that is what we're currently seeing. Recessionary fears as well are playing into the market here, so oil looks like it could continue lower and respect the overall macro thesis. Okay, taking a look here at sector rotation, we have 3 sectors in the improving and leading categories, and we have 8 in the lagging and weakening. So discretionary and technology, both in the leading category, finding some momentum and relative strength, moving to the right and providing a lot of leadership to the overall market. We have communications rotating out of the leading category into the weakening category, so losing out on momentum here after providing a few months of leadership. And we also have financials here, another big move. From the depths of the lagging category, it has managed to find a lot of momentum to rotate back into the improving category. The one thing I will say about this is that I think that the move here in the sector isn't really attributed to every stock in financials. What I've noticed is that the large banks are what's really lifting the financial sector higher. They tend to be outperforming the rest of the sector because the small banks, and we'll take a look at this in the next slide, but the smaller banks aren't doing too well. And a lot of this has to do with the fact that the Fed will be doing, stress tests for the banks this week, and there's some concern whether the small banks would actually be able to pass them. Now, the big banks, they have enough, they have basically enough money stored to pass these stress tests. However, the smaller banks, especially off the back of the banking turmoil that happened earlier this year, there are some concerns over that. So with financials, even though it's doing well, it doesn't mean every aspect of the sector is doing well. It's very much concentrated at the top with the big investment banks, and the regional banks aren't really participating in this trend. We have staples, healthcare, and utilities, our three defensive sectors, all losing out still. The last few days, we have definitely seen a slight shift to a more risk-off sentiment, and healthcare especially has been performing or outperforming the overall market. But I don't expect that to last long. I expect, with the risk on sentiment that we currently have, that the defensive sectors continue to weaken. Real estate and materials continuing to find some momentum and moving higher, but not too much. And we have energy continuing to move lower here, simply due to the fact that oil prices are declining still. And especially when oil prices are declining at a time when the major indices have been rising, energy will be the natural loser there. Okay, moving on to some subsectors of interest that I have for you today. It's just the one here, and that is KRE, which is the Regional Banking ETF. So KRE, part of the financial sector, but as you can see, huge underperformer. We had a strong move lower due to the banking turmoil, and since then, prices on the daily time frame, as you can see, has really struggled to break above the mid-40s. We have some resistance at around, let's say, 45, 46, around that area. More recently, price did retest that and has failed and has broken below its 21 and 55-day exponential moving averages. Price did attempt to pop up higher yesterday, but rejected. And I'm looking for a continuation lower here, KRE. I'll be looking for a move back down to 36. And that will bring it quite close to the pandemic lows that it experienced in 2020. So I don't expect price to move that much further lower than that. But KRE clearly underperforming the overall market and also its broader sector, which is XLF. Okay, moving on to some market observations. First one is a bearish idea actually on United Health. So this is a healthcare stock, and you might be surprised because obviously healthcare has been performing well over the last couple of days. I still do not believe that would last. I believe that during this pullback, once it's completed and once we get a continuation higher for the broader markets, we are going to see a risk on sentiment and rotation out of healthcare stocks. But for now, United Health has provided an excellent risk reward bearish opportunity at 480. So we have some minor support at this area. Price did manage to pop up higher after a gap down, and we are seeing multiple rejections of that 480 level. So I am looking for a continuation lower here for United Health. Looking at around the 450 level to the downside, which is a major support level. I don't expect price to necessarily break below that, and I'm not looking to play a trade on that. Just to move to 450 would be sufficient, in my opinion. Okay, taking a look at Nike. So Nike, is looking like a better bullish play these days. So starting off with the weekly time frame, the first level that I'm going to point out is the 130 area. Provided support on the weekly time frame and resistance. Price did form a bit of a double top here and moved lower. And since then, we saw a big bullish candle and price forming what is looking like a slight higher low. So it does look like, price is, finding some support, finding some momentum, especially after recovering from that oversold condition. And it's looking like it's gearing up for another nice bullish opportunity. The first hurdle it would have to clear is 160. That is a resistance level. But if we can get above that, you're looking at 128 as a potential secondary target here for Nike. Taking a look at Dollar General. So Dollar General is actually a bullish idea, although yesterday's price action was a little bit concerning. Dollar General is still oversold on the weekly time frame. So from a risk to reward perspective, it does favor the upside. However, on the daily time frame, we're seeing price run into some resistance once again. So going to take this idea with a pinch of salt because I'd like to see price break above its 21-day exponential moving average before looking for a bullish opportunity, because there's a huge gap fill here back to 200. And that's the opportunity that I am looking at here for Dollar General. especially from an oversold condition. But again, I'd like to see a pop-up higher back above this 21-day exponential moving average before getting into that trade. So moving on to Southern, so part of the utilities sector. And, we are seeing a resistance level at around, let's say 71.72. We have to be a bit more lenient with this resistance level. Price is respecting that area. Very choppy price action there, though. You can look at the momentum line, the 6-period CCI, very, very choppy, but still respecting resistance. And this provides a nice risk to reward bearish opportunity after what was a strong impulse move to the downside, followed by choppy price action to the upside. Ideal trade structure in this case would be a credit spread, in my opinion, because price action is still quite choppy and a credit spread can take advantage of that neutral movement in price. Downside target would be either 69 or even 65, which is a major support level. Taking a look at Carnival, which had earnings yesterday, upside surprise, but price did decline. Now, this is not an actionable idea just yet, but one to add for the bullish watch list. The reason I'm adding it to the bullish watch list is due to the fact that price has broken above an area of resistance with very strong momentum. And I'm looking for a bit of a pullback, and I'm using a Fibonacci retracement tool for that. Now, the 50% fib level at around 1250 lines up perfectly with the previous swing level, the breakout level, I should say. And that would be the best possible pullback zone, in my opinion. However, you could see price very easily bounce high from the 38.2 fib level. It's already rejecting, going below the 23.6 fib level as well. Either way, I'm just looking for a pullback, looking for some bullish price action to enter a nice bullish opportunity. Because Carnival right now is at pandemic lows. And logically speaking, I mean, I do think that sector is now doing a lot better than it was in the middle of the pandemic. So we are finally seeing a bit of a resurgence. And I think this is a nice early opportunity for what could be a long-term uptrend here back to pre-pandemic levels. Taking a look at BMY, so another healthcare name, and another bearish healthcare name, actually. This is quite a simple one. Playing on the resistance level at 66, you can see price is rejecting that, and I'm looking for a continuation lower. The overall trend on the weekly time frame is bearish. Price struggling to break above that 66 level, as you can see, previous area of support. And I'm looking for a downside move here back down to 60. So quite a simple setup here for BMY. Not a very volatile stock, so patience would be required, but it is looking quite bearish at current levels. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week ahead. I will see you next week for another market outlook. Goodbye.